Welcome to This Explainer. Today, we're circling back to the absolute core mechanics of building wealth over time. Now, we all know the stock market is this massive, powerful engine for growing your net worth, right? But let's be honest, even the most seasoned investors can kind of lose the forest for the trees in the day-to-day chaos of the market. So today, we're cutting through all that noise. We're going to dive into our source material and really refine the strategies that actually drive long-term success. It's all about getting back to those fundamental principles that separate the true professionals from the gamblers. So, right off the bat, we have to ask, is the stock market just some insider's game reserved for the ultra-rich? Wall Street definitely loves to project that intimidating image, don't they? The shouting traders, the high-frequency algorithms, those multi-million-dollar buy-ins. But the data from our source material proves something totally different. True market leverage doesn't actually require a massive initial fortune. No way. What it requires is an airtight grasp of the fundamental rules of the game. It really just comes down to strategic capital allocation, and that's true whether you're working with $1,000 or $1,000,000. All right, here is our roadmap for today. We're going to cover demystifying the stock market, 5 steps to start, choosing an investment strategy, navigating risks and challenges, and finally, the wealth building journey. Let's jump right into part 1, demystifying the stock market, uncovering the basics of investing. It's surprisingly easy to just view stocks purely as ticker symbols, or maybe just digital numbers flashing red and green on a screen. But if we want to be strategic, we have to anchor ourselves to this one fundamental truth. A stock is literally a small, fractional ownership stake in a publicly traded, operating business. You aren't just buying paper, you are buying a slice of a living, breathing company with real products, real employees, and actual cash flows. And keeping that perspective, that's exactly what prevents you from treating the market like a trip to the casino. And that brings us to the absolute core mechanic of wealth building. It hinges on this exact reality. We acquire these ownership stakes because as that specific company expands its operations, as it innovates, and as it becomes more profitable, the intrinsic value of your investment scales right along with it. Your capital isn't just sitting idle, it is actively participating in the economic growth of that business. When the company's earnings grow, the fundamental value of your equity grows, and that is what unlocks the incredible power of compounding over time. Moving on to section 2, 5 steps to start. Transitioning from theory to practical action. Okay, so building a successful portfolio requires a really concrete system. It starts with step 1, setting rigid financial goals. Are you looking for passive income or long-term capital appreciation? Once you know that, step 2 is learning the basics. Step 3, you choose a solid brokerage account to execute your trades. Step 4, start small and definitely diversify to spread your risk. And finally, step 5, you have to ruthlessly maintain a long-term perspective. Because honestly, without this structured step-by-step approach, investing pretty much just devolves into guessing. Let's zoom in on learning those basics for a second. Even the most advanced investors out there live and die by their mastery of these core pillars, really understanding what stocks are, how dividends work, spotting market trends, and, absolutely crucial, practicing strict risk management. Mastering these fundamentals is realistically the only reliable way to survive the noise of all those complex, high-frequency trading fads you see online. If you don't fundamentally understand the asset class or the macro environment, your risk profile just shoots through the roof. And speaking of risk, diversification is literally your primary defensive mechanism. By spreading your money across different stocks or entirely different sectors, you drastically reduce your exposure to a catastrophic loss. Look, going all in on a single stock might seem like a fun shortcut to massive returns, but if that one industry takes a hit, your entire portfolio takes the punch. A well-diversified basket acts like a structural safety net for your money, really smoothing out that bumpy ride. All right, next up, choosing an investment strategy, finding the right path for your goals.
This is where it gets fun. Your chosen strategy has to perfectly align with your personal goals. So let's look at the options. You might deploy value investing, where you're hunting for undervalued stocks and basically waiting for the broader market to wake up and correct that price. Or there's growth investing, targeting rapidly growing companies that prioritize aggressive expansion over current profits, like a lot of tech firms. Now, if regular cash flow is your thing, dividend investing secures a steady income stream that you can just keep reinvesting. And finally, for a super low maintenance, heavily diversified approach, there's index investing, which just captures the broader market's natural upward momentum.
Let's move to our next section, navigating risks and challenges, addressing the monsters in the dark. We have to talk about volatility because market volatility isn't an anomaly, it's literally a feature. Asset prices are going to constantly fluctuate based on massive external forces, things like economic changes, a specific company's performance, or completely unpredictable global events. These factors are 100% outside of your control, yet they dictate the daily valuation of your portfolio, which is going to constantly stress test your conviction. The real challenge here isn't trying to magically predict these events, it's entirely about managing your own reaction to them. Which brings us to perhaps the most dangerous risk of all, ourselves. Emotional decisions, like panic selling when you see red or getting way too overconfident during a bull run, those are the ultimate destroyers of wealth. Humans are predictably irrational when we're dealing with losses. Actually, behavioral economics tells us that the pain of losing money feels about twice as intense as the joy of gaining it. So having strict discipline, sticking to your predefined plan, and having an iron stomach, those are your absolute best shields against market psychology. And that leads us to our final section, the wealth building journey, staying the course for long-term success. Staying the course means you have to treat investing as an ongoing discipline, not just a one-and-done event. It means you're doing thorough research to continuously update your thesis. You're avoiding the trap of putting all your money in one stock. You're staying objectively updated on market trends. And above all, you are being patient and avoiding those emotional decisions we just talked about. Real generational wealth isn't a lucky overnight trade. It's the result of compounding patience and steady execution over decades. Because remember, the stock market generates noise every single day. That's a given. But if you zoom out and look at the historical data, the overarching trajectory of the broader market has reliably trended upwards over time, driven by human innovation and economic expansion. All that day-to-day volatility, the media panic, the short-term dips, they really just fade into the background when you take the long view. Successful investors survive by focusing strictly on that long-term horizon and deliberately tuning out the daily static. At the end of the day, the stock market is arguably the most powerful wealth creation engine in history, and it only requires knowledge, discipline, and a defined strategy to harness. The broader market is going to keep growing, innovating, and evolving, presenting massive new opportunities for anyone prepared to capture them. So the only question left for us to answer is, what is your specific strategy for growing with it? It might just be time to refine your approach and claim your slice of the pie. Thanks so much for joining me for this explainer, and I'll catch you in the next one.